If you want to manage your money like the top 1%, there are 5.5 things that you need to do. And if you stick with me until the end of the video, you're going to know exactly how to do that. I'll show you. Number 1, you have to build a foundation for your finances. I'll explain what that means. Number 2, you have to build an investing system. This is where your wealth is going to be built through your investments. Number 3, you have to build a conscientious spending plan with the money that you're generating. Number 4, you have to figure out how you can grow your income strategically. Then number 5, you have to figure out how to protect your assets. Every wealthy person puts a lot of emphasis here on their asset protection because as you make more money, people are going to want to take some of that money for themselves. And then number 5.5 is you have to have the right mindset, because even if you have all the financial education, if you have a broke mindset, it is going to be impossible for you to become wealthy. So let's dig in by starting by talking about number 1, laying the foundation for your finances. The majority of Americans statistically do not have $1,000 saved up to protect them against an emergency. So what happens for the majority of people when you run into an issue like your car breaks down, your window breaks, your kid breaks their arm? The majority of Americans have to then turn to credit card debt, which is why credit card debt has become such a big problem in the United States. And this is where, if you want to be able to break out of this mess, of this system of constantly relying on your next paycheck to make yesterday's bills, what you need to do is start by laying the foundation. And I know this one's a little bit difficult because everybody wants to start by just investing their money. How do I build my wealth? Well, you can't do that unless you lay the foundation first. If you wanted to build a home, what would you do? You got to first dig the foundation. If you wanted to build a tower, what would you do? You got to dig a deeper foundation. So if you want to build your wealth up, you have to start by going down and lay that foundation for your finances. And what I want you to do here is first, I want you to go out and save $2,000 as fast as possible. And then once you save that $2,000, I then want you to go out and pay off your high interest debts. That means things like your credit card debts and your payday loans. And the reason why I want you to do it in this order, get the $2,000 first and then pay down the high interest debts aggressively, is because if you pay down, or you're working to pay down those high interest debts, and then something happens, your car doesn't work or your AC stops working, what's going to happen? You're working to pay down the debt, but then you find out your AC stops working, and then you have to pay somebody to fix that with money you don't have, which means you end up deeper in debt. And that's why I want you to first work on aggressively working to save $2,000 as fast as possible. The reason why you need to do this is because if you don't have $2,000 saved up, you're in what I call financial danger zone. So I want you to be extremely aggressive on this. That means no eating out of restaurants, no spending money on anything that you don't need in order to survive until you got the $2,000 saved up. Now, when you got this $2,000 saved up, what I want you to remember is this $2,000 is not money you're going to go out and shop with. It's not money you're going to go out and invest with. It's not money you're going to go out and spend. This is $2,000 sitting there to protect you against something going wrong, against life's emergencies. Think of it like your rainy day fund, your emergency fund, whatever you want to call it. This $2,000 is money you have to put aside because the reality is life happens to everybody. And if you don't have some cash put aside, you're going to be the one that's going deeper into debt to solve that problem. Once you got the $2,000 put aside, now I want you to stop saving more money, and then I want you to take every additional dollar that you earn and aggressively pay down your high interest debts, your credit card debts, your payday loans, your whatever 0% APR loans that you didn't pay off in time. These are the things that I need you to pay off ASAP, because when you're paying 15, 20, 25, 30% in interest to your lender to borrow money, you will never have the ability to ever build wealth. When you invest your money into something like the stock market, you're trying to get a 7 to 10% return. That's the average historical stock market return. Well, if you're trying to grow your money by 7 to 10%, but then you have to pay 20 to 30% to your lender, it doesn't make sense for you to invest because all of your money is going to make your lender rich. And this is where you have to stop making your banker and your lender rich. And this means you got to pay down the credit card debt as fast as possible. Now, there's a lot of different strategies that you can follow to pay down the credit card debt. You could follow the debt avalanche method, the debt snowball method. The debt avalanche method means that you're going to pay down the debts in order from the highest interest rate to the lowest interest rate. The debt snowball says that you're going to pay down the smallest debt balance first, and then you're going to slowly work your way up to the larger debt balances. I don't care which one you follow. All I want you to do is get aggressive in paying down these high interest debts as fast as possible, because these debts are what is keeping you back from ever being able to build wealth, because now anytime you make money, your money is going directly to the banker, is going directly to the lender, and you're never going to have a chance to build upwards until you lay this foundation. So you got to figure out now, how can you save your first couple $1,000s and pay down this credit card debt as fast as possible? That might mean no more spending money. That might mean you got to sell your stuff. That might mean you have to sell your car. That might mean you have to sell your apartment, or move out of your apartment, or move out of your home and downsize. That might mean you have to sell your furniture. That might mean you have to sacrifice going on the vacation. That might mean you have to say no to going to that wedding. That might mean you have to say no to going to that bachelor party. There are sacrifices required to doing this. It is not going to be easy. You didn't watch this video thinking that it was going to be easy, did you? Maybe you did, but it's not going to be easy. It takes financial sacrifice, because while everybody on the internet is going to talk about how I can make $1 million without putting in any effort, the reality is that doesn't work. You have to be willing to make the sacrifice and put in the work. And the first thing you got to do is build that foundation, which is bringing us to number 2, which is now building an investing system for your money. What every single wealthy person does well is to pay themselves before they pay everybody else. And what that means isn't that you're going to go to the Gucci store and buy yourself something nice before you go out and buy things for other people. What that means is you are going to invest this money to make you more money before you go out and spend all your money on things that lose you money. And in order for you to do that, what wealthy people do, and what I want you to do, is they create a system. They give jobs to every dollar that they earn. They know now, if I generate $1,000, how much of this money am I allowed to spend? How much of this money do I have to invest? And how much of this money do I have to save? They build a system like this, that way no matter how much money they earn, they're always investing some of their money, they're always saving some of their money, and they're spending whatever's left. The majority of Americans, what they do is they make money, they spend their money, and then if there's any money left over, then they might save it or they might invest some of it. But you want to flip this. And this is where you have to create a strict system. And this is difficult, especially when you're struggling with your money, because you might feel like, if I'm already struggling paying my bills, how in the world now do you expect me to start investing my money? How in the world do you expect me to start saving some of my money? I'm already living paycheck to paycheck. And this is where the way I want you to think of it is, if tomorrow the United States government imposed a brand new tax on you, what would you do? You might kick, scream, complain, cry, but eventually you're going to figure out a way to pay it, because you're going to have no other option, because if you don't pay your taxes, you're going to end up in jail. Well, this is where you got to do the same thing. I want you to tax yourself. But instead of giving your money to the government now, you're using your money to make yourself richer. And this is where you can create a financial system that works for you. One of the things that I like to talk about is a 75-15-10 plan. This is a very simple way to start, and you can adjust this to whatever works better for you. But 75-15-10 says that for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. And the best way for you to do this is to go to your bank, create 3 different bank accounts. And you want to create 3 different bank accounts, because if you keep all this money in one bank account, well, it's going to be very hard for you to know how much of this money you're supposed to invest or save or spend. So I want you to create 3 different bank accounts, and then create automatic withdrawals. That way now, when you get paid, some of your money will automatically be pulled out of that first bank account and be put into a second bank account, which holds your investing money. And some of this money will automatically be pulled out of this first bank account and be put into your third bank account, which is your savings money. Now, you can't spend this money or this money because it's not in your spending account. And now when you don't see the money, you're going to be less tempted to spend it, because this money can be automatically invested. This money can be automatically saved. And now the question is, well, what do you actually do to grow your money and build your wealth? Now, when it comes to savings, let me just start by talking about that. Because your savings are not there to make you wealthy. Now, I know a lot of us growing up thinking that you need to save your money, build as much of a savings cushion as possible, because that's what's going to make you wealthy and secure. Your savings are not there to make you wealthy. Your savings are there to protect you against an emergency, period. Because the reality is, when you have high inflation, your savings get eaten away by inflation. And this is where now, understanding that inflation has been around for a long time and it's going to continue to be around for as long as we can foresee, you want to save money to protect you, but not rely on your cash to be there to build wealth. That's what your investments are for. So when you save your money, you want to have somewhere between 3 to 12 months worth of expenses saved. And I know it's a big range, but it's going to depend on where you are in your financial situation. If you're 45 years old, you got a spouse, you got kids, you got other financial responsibilities, you got to take care of your parents, and you don't have a very high risk tolerance, maybe you need 6, 9, or 12 months worth of savings put aside to make you feel a little bit more secure. If you're 23 years old, you got your first job, you have no financial commitments, no financial responsibilities, you don't need to worry about having 6, 9, or 12 months worth of savings put aside. You can be a lot more aggressive right now because you're young. Now maybe you only need 3 to 4 months of savings put aside because now you can be even more aggressive with your investments. So the amount of money you save is going to kind of vary depending on where you are in your financial situation, in your life situation, but you have to keep working on building these investments because this is where your wealth is going to be built. Now, there are a couple ways for you to invest your money. This money can be automatically invested, or this money can be more manually invested. Like if you're investing into something like a 401k or an IRA, you might have automatic contributions. That can be a part of this, but I don't want you to solely rely on your 401k to retire or become financially free, because what's going to happen for the majority of Americans is the majority of Americans are going to hit retirement and realize that the 401k wasn't enough. In fact, the founder of the 401k has even come out and said that the 401k has gone awry because so many people are relying just on the 401k to retire financially free. I do not want you to do that. So you can have automatic contributions to things like your 401k or IRA, but that's not enough. I also want you to continue investing your money on your own. Now, when you're investing your money on your own, again, this could be automatic or this can be non-automatic, manual. And that is going to be a little bit more up to you on what is the right type of financial investment for you. If you want to just passively invest this money, automatically invest this money, that means now this money is going to be automatically pulled out and invested into your portfolio of stocks, ETFs, index funds, maybe it's real estate crowdfunded deals, whatever it might be. You might not even need a separate bank account for your investment money because this money can be pulled directly out of this account and automatically invested. Or maybe you think, I want to be more involved. I want to find startups to invest in. I want to invest in businesses. I want to invest in stocks. I want to go out and invest in real estate. Well, now in order to do that, you might need more cash put aside, in which case now you can start building and accumulating a cash pile here. That way now, when you find a good investment opportunity, you have the cash to go out and invest. But the key is you have money to be invested. The way that you invest your money is going to vary based on your investing strategy. And there are so many different investing strategies. Like I invest my money passively, I invest my money actively, I invest my money in real estate, I invest my money into individual stocks, I invest my money into ETFs, I invest my money into startups, I invest my money into my own business. So there's a lot of ways that you can invest your money, and I'm not here to tell you, you got to invest your money this way, because what works for you might not work for me. But the key is that you have to have this money being put to work to invest, because this is what's going to make you wealthy. Now, I'm not going to do a full deep dive of all the different ways that you can invest your money in this video, because that would make this video very, very, very long. So if you want to learn more, my team at Briefs Media put together this amazing ebook on how to build wealth as an investor that you can read for free. And this ebook starts with the basics of, well, how do you build the mindset of an investor, to understanding the economic system, to then what are the different ways that you can invest your money, how do you invest for cash flow, how do you invest your money other ways, and then how do you spend your money smartly, how do you earn more money, and how do you protect your assets. Kind of like what we're talking about in this video. So if you want to read this ebook, it is completely free. All you got to do is click the link down in the description below. The last thing that I'm going to say about your investments before I move on to here is there's a couple of different ways that you can get paid with your investments. You can get paid with cash flow, or you can get paid with appreciation, meaning I bought a stock for $100 and now it's worth $200, and now I can sell the stock and make a $100 profit. The majority of my investments are cash flow investments, meaning the majority of my investments, not all of them, but the majority of them are paying me with some sort of cash flow, because I like cash flow. And the reason why I like cash flow is because when I have cash flow, I can get paid without having to sell my assets. So as you think about now you investing your money, I also want you to think about, how do you want to get paid? Do you want to get paid more with cash flow, or would you rather see more of that appreciation and see more of a growth of the value of your investments? Neither of them are bad. You just got to figure out what's right for you. This brings me now to the third point here, which is, what do you do with this money that you spend? Which brings me to number 3, spending your money smartly. There's a running joke that I make when it comes to spending, which is that American people make $1 to spend $2, while Indian people make $1 to spend 20 cents. And the reason why is because the cultures are very different and the mindsets around money are very different. An Indian person, a traditional Indian mindset person, I can tell you this from experience because I grew up in a very traditional Indian house. You work to earn money to save as much money as possible. You will make $100,000 so you can live off of $30,000 a year and then save all that other money. But what you see happen with a lot of Americans, yes, I know I'm generalizing. If you're offended, you can leave this video. With a lot of Americans, you make money. That way you can finance it and spend even more with credit card debt and other forms of credit. And this is where now neither of them are right. But you want to understand how to spend your money smartly. And what this means now is it is very easy to buy things, especially in America. You can buy things with credit cards. You can buy things with lines of credit. You can buy things with buy now, pay later, or as I like to call it, broke now, broke later. But the key is there's a difference to being able to afford something and being able to buy something. See, when most people think about being able to afford a new phone, they think, oh, I can make the $50 payments. But you're not actually affording the phone. You are buying the phone. And so what I want you to do is start reframing that question of what does it mean to actually afford something? And the first thing that I want you to understand and remember is if this thing does not put money in your pocket, you should not be financing it, period. The only exception to this would be your house. Even when it comes to your car, I don't like financing cars. I do not recommend financing cars. Now, I'm not a financial advisor. I can't recommend anything. However, financing cars means you're paying interest to drive around in a car that's losing value. Now, if you're making a ton of money, if you're very wealthy and you want to lease a car because you just don't want to have to deal with the maintenance and you want to keep flipping cars, fine. But you got to understand that when you're leasing a car, it's kind of like flying first class. You can get to the same place by flying economy. You're paying for that extra luxury. So if you can afford that extra luxury, fine. It's the same thing with leasing a car. When you're leasing a car, you're paying for that extra luxury. Anything wrong with that? No, but you're buying a luxury. You got to make sure you can afford that luxury. And if you're struggling with money, if you don't have any cash flow coming in, you don't got your dividends coming in, you don't have that financial foundation built, you should not be financing or leasing cars. And this is where right now I want you to go back to what does it mean to buy something versus being able to afford something. And a simple rule of thumb that you can follow, which I know is hard, especially when it comes to things that you don't need to survive, is to follow my rule of 5, which says if you cannot buy 5 of them, you cannot afford 1 of them. Now, this means if you want to go out and buy that same $1,000 phone, making the $50 a month payment does not mean you can afford it. If you want to be able to afford that $1,000 phone, that means you have to have the cash in the bank in your spending account to be able to buy 5 of them. You have to have $5,000 to go out and buy that $1,000 phone, and that means some of you might have to downgrade some of your purchases. Maybe that means you don't always buy the newest iPhone. Maybe that means you don't always buy the brand new Lululemon pants. Maybe that means you don't buy all that Gucci, and you got to downgrade a little bit, which is difficult. But when you do that, you're going to have more money here, which can give you more money to spend here, and this means you can make even more wealth. And this is where, it helps for you to kind of remember the difference between a want and a need. Because now you might be saying, but Jaspreet, what do you want me to do? I have to get to and from work. I need a car. Yeah, you need a car. You just want the BMW. You need clothes. You just want the Gucci. And this is where there's a difference between what you want and what you need. And this is what gets very difficult because that means you might have to sacrifice a little bit of the lifestyle. Now, I don't want you to permanently sacrifice it. The whole point of being financially smart isn't so you never enjoy your money. It isn't so you can never buy the nice things that you want. It's so you can afford the nice things that you want without having to worry about money, without having to worry about the cost. But in order for you to get there, that requires you to make a sacrifice today. That way you can actually have the nice things and never have to worry about money. And if you make the sacrifice, what will be funny is you're going to have to go through this kind of little slump where everybody around you has all the nice things. They're bragging about how much money they have. They see you not having the nice stuff, and they're going to be kind of wondering what the heck happened to your finances, what happened to your household. And then a few years later, you'll see things start to flip. You'll see them struggling or talking about how much their bills are difficult and how they're struggling making their payments. And then you go out and start buying the nice things. and you don't have to worry about the price. Now, all of a sudden, you went from being that person that everybody wondered what the heck was wrong with them to being the person that people are coming to for financial advice. But that requires you to make that sacrifice and put in the hard work that most people are not willing to do. The fourth step to managing your money like the top 1% is now focusing on income growth. See, if you ask the majority of people today, what is stopping them or what's causing their financial issues? Every single one of them would say, I'm not making enough money. But what we have seen happen statistically is when the majority of Americans make the extra $10,000, they go out and spend that $10,000. Actually, they go and spend an additional $13,000 because now when you make the 10 grand, you can qualify for more credit on your credit card. You can qualify for bigger lines of credit. You can qualify for more money from the bank. And so people now make an extra 10 grand a year, but then they spend an additional $13,000 a year. Because now as you make more money, you got to go on a nicer vacation, you got to drive a nicer car, maybe you got to upgrade that apartment or your home, you got to have the nicer appliances. And so now you make more money, but you end up in a deeper financial hole. That's why parts number 1, 2, and 3 were all about now money management. Number 4 is about money growth. And this is where now understanding that once you have this financial system working, you know how to save your money. Once you save your money, you invest this money right here. You know how to invest your money. Maybe you're generating cash flow. Maybe you're generating the appreciation. But you know you're always putting your money to work. You're investing your money before you pay yourself. And then you spend whatever's left. And now you realize, I just want to put some more fuel on this fire, baby. And now you got to figure out how you can grow your income. And this can be maybe a career change. Maybe this can be working harder in your job. Maybe this can be a promotion. Maybe this can be getting a second job. Maybe this can mean working on a completely new industry, figuring out a whole new job, a whole new thing that you can do. Or maybe this means starting a side hustle. Maybe this means starting a business. Now, if you talk about what do the 0.1% of people do or the 0.01% of Americans do, how do you build that much wealth? Well, now you're going to have to work to build your own business, because when you invest your money, what you're doing is you are growing the money that you have. And the reality is if you're making $50,000 a year, $100,000 a year, $500,000 a year, you can make a few $1,000,000 and you can build millions of dollars worth of wealth and retire very financially free. But if you want to fly in private jets, if you want to have that very exotic lifestyle, you have to have way more money working for you. And the way that you can attract and accumulate that way more money is you're going to have to go out and take more risk. And in America, the number one way that has built more wealth than anything else is by going out and starting a business. Now, building a business is hard, it's risky and all that stuff. I'm not going over that in this video. However, what the 0.1% and the 0.01% do is all of them are business owners to some extent or capacity. Maybe their business is investing in businesses. Maybe their business is starting a business. Maybe their business is some sort of real estate development or investment. But you have to have some sort of business involvement if you want to get to that level. However, in any case, even to be part of the 1% now, it's all about now how do you grow your income? That way you can have more money to invest. And this can be a whole slew of opportunities, whatever you feel is right for you, but now you're working to earn more money smartly. That way you have more money to make you actually wealthier instead of just to drive a faster car. Number 5 is as you start building your wealth, you also want to start investing in advisors that can help you protect your assets. Because as people realize that you have money, they're going to try to take their hands, put it in your pockets, and take some of that for themselves as well. I'll give you a quick example. Earlier in this video, I told you that I invest in real estate. Now, while that's true, it's not exactly true. Let me explain why. Let me diagram this person with a nice mustache as me. And let's say this is a rental property that I own. Well, this property that I own is not actually owned by Jaspreet Singh. I actually own 0 rental properties. They're just not under my name. And what that means is now this property isn't owned by Jaspreet Singh. Instead, it might be owned by an LLC. An LLC is a type of entity. It's a type of company that you can create. It's just a legal term. Your attorneys can help you with this. But now this property is owned by an entity. Let's just call it Jaspreet Singh LLC. Jaspreet Singh doesn't own any real estate. Jaspreet Singh LLC does. Now, Jaspreet Singh owns Jaspreet Singh LLC, but Jaspreet Singh LLC owns this property. And the reason why this is important is because now let's assume that there's a tenant living in this property. They slip and fall, and they sue the company for $5 million. Now, again, they can't sue me because I don't own the property. I just own the company. So they sue the company for $5 million. Let's assume this property is worth $200,000. Now, worst case scenario, insurance doesn't cover the claim. And then the judge says, well, this company, you were entitled to pay the tenant $5 million. Well, if the only thing that this LLC owns is this property and it's worth $200,000, you declare bankruptcy, the tenant gets the property. So the max they're entitled to is whatever is in this LLC. They cannot come after my personal assets, assuming I treat this LLC as its own business. I'm not using the LLC money to pay for my groceries directly. I have my LLC bank account and I have my personal bank account. If I treat this like a real business, that means the most that the tenant can take out of this LLC is whatever's in the LLC. And this is just one form of protection that you can have. And as you start to invest your money, as you start to build your assets, what you're going to want to do is build layers of protection, because the reality is America is the most litigious country in the world. How do I know that? Well, I am a licensed attorney. So I can tell you from a little bit of experience that America loves lawsuits. Anybody can sue anybody for anything. And, well, lawsuits are expensive, so you want to protect yourself. And one way to do that is to have things like LLCs in place. Now, it might not be an LLC for you. I can't recommend what you need because I don't know what your financial situation is. So this is where you want to have the right advisors. That means attorneys. That means tax advisors. That means estate planning attorneys. You want to have the right people on your team that can protect you and guide you, especially as you start building your wealth. And I know nobody likes paying for attorneys. Nobody likes paying for tax accountants. But these things, while they cost you a little bit of money today, they can save you a whole lot of money and a whole lot of headache in the long term. And as you start to build more wealth, you want to make sure you invest more money here as well. And then we have point 5.5, which is your mindset. And the reason why I always like to talk about this is because a lot of us, myself included, did not grow up with financial education. I grew up with a very negative attitude towards money and this whole idea of building wealth, because in my household, it was this thing that was taboo and bad, that rich people are bad and you shouldn't think about money that way. But at the same time, I saw how hard my parents were working to generate money. So it just didn't make sense to me. We're talking about how bad money is, yet you're going to work every single day to get money. You don't get breaks, you don't get days off. It doesn't make sense, because if you had money, you could take vacations, you could take days off. You wouldn't have to stress so much about money. And that's where I started to think a little bit different about money. And I started to realize that money is just paper. It's just fuel. It amplifies who you are. You give a good person money, they have a tool to do more good. You give a bad person money, they have a tool to do more bad. And this is why we need more good people with money. And that means, number one, you have to change the way that you look at money, but then also change the way that you think about wealth. Because if you don't grow up with wealth, it's very easy to create this negative connotation towards wealth, because it's never something you've been exposed to. So it's, oh, it's that thing. It's those people's thing. It's this greedy, slimy person thing. It's this bad person thing, because it's not something that you're associated with. But if you constantly have this negative connotation and attitude towards wealth and wealthy people, you're not going to want to actually achieve that yourself, because we don't want ourselves to go out and be bad people, right? Like, you don't try to go out and do bad things. You try to do what you think is good. And so if you think becoming wealthy is bad, even if you kind of subconsciously think that, you're going to change the way that you think, you're going to change what you do, and you're going to change what you receive. And so if you want to now actually become wealthy, you can't have such a negative attitude towards wealthy people and wealthy things. You have to start asking the question of, how did they become wealthy? And how can I become wealthy? And what do I need to do to achieve that wealth myself? Because when you start asking, how do I become wealthy? As opposed to, oh my God, they're wealthy, that's bad. Now you start asking the right questions. And now you start opening up the way you think. And you start opening up where you learn. And you start opening what you do. And that also starts changing what you receive. And this is where I want you to start working on your mindset. And this is, there's a ton of content on YouTube and podcasts you can listen to. Start with some personal development education on how you can change the way you think. And even if you feel like you've never had this bad attitude towards money, if you've never really invested in your personal development or that kind of mindset education, just spend a little bit of time learning about it and see if you can start priming yourself to think a little bit bigger, to think a little bit wealthier, to think a little bit more abundantly. because that's just going to help you achieve more. Because I'm not all about saying, oh, all you got to do is sit there, think positively, and everything's going to come to you. That's not what I'm trying to say. But you have to have this kind of positive attitude towards money if you want to achieve it yourself, because you got to know what to do practically, but you have to have the mindset that's going to allow you to actually achieve it. Passive income is the idea that you can make money without doing any work, and that whole concept is kind of true, but it's also kind of a lie. There's no true way to create an income that will pay you forever without you having to do anything. There are 3 general ways that I generate cash flow, and some of these are way more passive than others. They are PRR,